Hello, I'm John Ward on behalf of Physical Gold Fund and Anglo Far East, and we're delighted as always to have with us here Jim Rickards. Mr. Rickards is an investment banker and investment advisor based in New York, and he also serves on the Investment Advisory Committee for the Physical Gold Fund. Jim is the author of the New York Times bestseller Currency Wars, The Making of the Next Global Crisis, and most recently, he's the author of The Death of Money, The Coming Collapse of the International Monetary System, also a New York Times bestseller. Welcome, Jim, and thank you for joining us.
Great to be with you, John.
Jim, we asked our listeners to suggest questions for you this month, and we're grateful to have received some lively questions. But first, could we just catch up on recent events in the monetary world, and in particular the June meeting of the Federal Reserve's Open Market Committee? What caught my attention was a warning from the Fed that investors are showing a lack of caution. Is the Fed beginning to worry about a stock market bubble? And if so, is there a little touch of hypocrisy here? Should they perhaps be asking themselves who created the bubble?
Well, those are both very good questions, John. First of all, you're exactly right about the Federal Open Market Committee meetings from June. There was this discussion, this warning, but it's even more timely than that. As we are doing this interview, Chairwoman Yellen is completing her testimony to the U.S. Congress. There are a couple times a year she goes up and testifies, and she has repeated exactly that, actually with more specificity. She points specifically to the social media sector and the biotech sector, or the pharmaceutical sector, as being a little bubblicious. I didn't know where Janet Yellen got her stock picking credentials, but she's not only warning about stock bubbles in general, but pointing to specific sectors where she thinks there's an overvaluation. Of course, this is consistent with the notion that I've talked about that you cannot manipulate one thing. Clearly, the Fed starts out manipulating interest rates. They're not supposed to manipulate interest rates. They may be maybe their job to set interest rates to basically conduct monetary policy in a way that optimizes labor conditions and smooths out economic cycles a little bit. That's probably bad enough. Query whether they're even very good at that, which I doubt. But to go beyond that and actively manipulate interest rates, which of course is what quantitative easing and Operation Twist and currency wars and other things are about, is too much. But you cannot stop there. Once you manipulate one market, you end up manipulating all markets because, of course, interest rates are the price of money. Money is the medium in which every other asset class is denominated. So here we are, 5 years into this experiment, and an experiment is the right word. The Fed have said themselves, and I've had private conversations with Fed governors where they will candidly admit that they are making it up as they go along. This is a gigantic world historical monetary experiment. I guess we as investors are all the guinea pigs. But now it's to the point where you have the chairwoman of the Federal Reserve testifying before Congress, picking out a particular sector of the stock market, social media stocks in particular, saying it might be overvalued. I mean, what's the basis for that? It just goes to show how far things have gone, how out of control it is. Now, as to the cause of the bubble, there's no doubt about that. But first of all, it's unusual for the Fed to even acknowledge bubbles. I mean, you go back not very far, certainly in the late 90s, early 2000s, the Fed was so wedded to the efficient market hypothesis and notions of normal distribution of risk and mean reversion, et cetera, that they would say, well, bubbles didn't exist, because the definition of a bubble is things are kind of irrationally overvalued. Well, if something's overvalued, wouldn't it be logical that people would sell the overvalued asset and that would drive prices down? There would be this mean reverting behavior and it would be self-equilibrating. It's a classic standard equilibrium model, and it's all good. So it's only very recently that the Fed has even sort of grudgingly come to the view that bubbles exist, and their failure to avoid the dot-com bubble in 2000, their failure to avoid the housing bubble in 2007 are direct evidence of the fact that they don't understand bubbles. Now, I think there's been some progress there. I think if you lose $60 trillion, which is the total global wealth loss from peak to trough in 2008, 2009, it's kind of hard to deny that something bad was going on. So they've sort of tiptoed up to the subject, but still don't take responsibility for it. But there's a lot of evidence, a lot of research I've seen recently, which simply correlates the S&P to the Fed's monetary ease in the form of QE1, QE2, two flavors of QE3, Operation Twist, and so forth. And the correlation is perfect. I mean, they print money and the stock market goes up. That's evidenced by other things. Leverage on the New York Stock Exchange is at an all-time high. We've seen the stock market reach these peaks on very low volume. So that combination of high leverage and low volume is almost the definition of a bubble. So, yes, the Fed is creating bubbles. They're slow to recognize them. I think one thing we can count on is that it's too late to ease out of this. When I say ease, I'm not really talking about tightening, easing monetary policy, but the idea that you could get out of this bubble economy without a crash, it's too late for that. The bubble's already here. The blunders have already been made. We should expect the crash sooner than later. I'm not saying tomorrow morning or in the next 30 days, although that's possible, but sooner than later, meaning later this year, sometime in 2015, I think we'll begin to see some very severe downdrafts, and they will be directly attributable to the Fed's ignorance of how markets actually work.
So, Jim, if and when there is this stock market correction that you're predicting quite confidently, let's think systemically, as I know you like to think. What are the knock-on effects that you anticipate from this coming crash?
Well, of course, there are many knock-on effects. So it starts to play out in certain markets. So you might, of course, I've been one saying that the dollar is being sidelined and weakened as global reserve currency. There's a lot of activity around the world. We see some of it coming out now in the BRICS summit in Brazil, other actions by Russia and China bilaterally and unilaterally, et cetera. So there's a lot of activity all designed to diminish the role of the dollar as the global reserve currency because too many of our trading partners and financial investment partners are sick of the U.S. using the dollar to do things that no one else can do. Run trade deficits, run budget deficits. There was an enormous uproar in France, and I don't think we've heard the end of it, that the U.S. extracted almost $9 billion from BNP, one of their largest banks, as penalties for violations of certain U.S. law. But the strange thing about that was that the things that the bank was alleged to have done took place in France, Switzerland, and Iran, completely outside of the U.S. jurisdiction. Of course, these are French banks and Iranian counterparties, but because the transactions were denominated in dollars, and because those dollars had to flow through a settlement system controlled by the Federal Reserve and the U.S. Treasury, they became subject to U.S. jurisdiction, even though there's nothing about their charter or their operations or anything else for that matter that would, on the face of it, have subjected them to U.S. law. So there's an example. Again, I don't want to argue the merits of that. I think that you can argue the merits both ways, but simply the case that trading partners, including allies in the United States, are fed up with this dollar system. So they're moving away from it as quickly as they can. Having said that, in a crisis, the dollar tends to strengthen in the very short run because there is this flight to quality, fear trade, where people say, I may hate the dollar, I may not like the way that the U.S. abuses its dollar position, but in the short run, there's no safer place to go, and so I'll go buy some dollar assets. So you would see Treasury securities rally. You would see U.S. interest rates come down. We could certainly expect gold to go up. And so those are sort of the immediate effects. But beyond that, this is very important, John. I think what you might be getting at with regard to your question, beyond these sort of knee-jerk reactions, you're going to see something else, which you always see is a liquidity crisis. A lot of times when people are afraid, they just say one thing: I want my money back. Doesn't matter if you're invested in alternatives or highly liquid things like money market funds or treasuries, or less liquid things like hedge funds or alternatives, or something in between like the stock market. Everyone just says, I'm out. I want my money back. We saw that in 2008. We saw it in 1998. Interesting, two global liquidity crises exactly 10 years apart. I don't know if that means the next one will be in 2018 or not, but somehow I don't feel we'll make it that far. But when this dynamic gets underway, this liquidity crisis, the last two times it happened, the response was to provide the liquidity, say in effect, hey, if you want your money back, here's your money, take all you want, and we the Wall Street, we the Fed, we the Treasury, we the G20, we the sovereigns will provide all the liquidity that's needed so investors can get their money back until the panic's over, and then hopefully things will gradually be restored to normal. I do think the next time will be different, and I know that's a risky thing to say. People say, well, it's always the same, and the minute you say things will be different, you'll be proved wrong. But I do think this will be different because of the scale of the problem, because all the problems in 2008 were not addressed. The too big to fail banks are bigger. The derivatives books are bigger. The concentration of assets is great, et cetera. When you look at all the objective metrics, the system is more densely networked and more vulnerable to a systemic collapse than ever before. And a lot of the policy that was pursued in the last crisis cannot be replicated. What I mean by that is the Fed has taken its balance sheet to almost $4.4 trillion. They have not reversed that. That money printing and the assets they acquired are still on the balance sheet. So what will they do the next time the world needs liquidity? Will they take it to 8 trillion? I don't think so. I think that there are political and confidence and psychological and other limits. I think the Fed knows that themselves, which is one of the reasons they're trying to tiptoe out of it. But there's no way to tiptoe around a global liquidity crisis. That will hit you right between the eyes. And Europe and Japan and the Bank of England and the People's Bank of China are no different. They've all massively expanded the balance sheet. So since they did that to solve the last crisis, and since the next crisis will be larger, and since none of that policy has been withdrawn, they're going to be incapable of replicating it, which means that one of two things is going to have to happen. One is that there'll need to be another source of liquidity, which would be the IMF and the special drawing right now. It's funny, I mentioned this, I talk about it a lot, I talk about it in my book, and somehow I'm accused of being an advocate for SDRs. I'm not an advocate for SDRs. I'm just telling people they're coming. Whether I like it or not, whether you like it or not, is irrelevant. What matters is the global power elites like it, so you should expect to see that as one of the solutions. Printing is the right word because the IMF just says their own printing press. They print these special drawing rights. So they will print trillions of SDRs. They're worth about $1.50 each. So again, multiple trillions of US dollar equivalents. Hand them out to the members, and that will be one way to flood the zone with liquidity to snuff out or subdue a liquidity crisis at a time when central banks would have surpassed the outer limit of their capacity to do so. But there's another solution which is becoming more and more apparent, which is to say, you know what? You can't have your money back. In other words, investors will want their money back, and the classical solution is to give it to them by printing money. But the next time they may say, you cannot have your money back. It's funny how the power elites always use funny names to mask what's actually going on. That when they wanted to start a central bank of the United States in 1913, they called it the Federal Reserve. Funny name, what the heck is a Federal Reserve? Well, it's the Central Bank of the United States. They just didn't want to call it that because they knew that Americans don't like central banks. In 1969, when they wanted to create world money, they called it the Special Drawing Right, or the SDR. Oh, what the heck's an SDR? And very few people understand it. Well, it's world money. So, again, they don't like to call it what it is, but it's very transparent what's going on. The same thing is true now. The bail-in or the lock-in or the inability to get your money back in a liquidity crisis, this goes by the name macro-prudential regulation. So I've said on my Twitter feed, whenever you hear the word macro-prudential, think to yourself bail-in. Think to yourself freeze, asset freeze. I can't get my money. That's what they mean by it. And this is not speculation. I do emphasize to listeners and readers of my books that I am an analyst. I obviously work hard at these things, but I don't make it up, as the saying goes. There's concrete evidence of this. The SEC, the U.S. Securities Exchange Commission, has just announced, and these will be finalized in the next week or so, new money market regulations. And the money market regulations will allow the SEC, by order, to do something that they call suspend redemptions. Well, suspend redemptions is just a funny name for you can't get your money back. Right now, if people have money market funds, they think they're equivalent of checking accounts. They think that they can get their money back tomorrow or later today. And right now you can. But under these regulations, the next time there's a crisis, the SEC will be able to say, sorry, you cannot. Now they'll say, we're not stealing your money. It's only temporary, just till the panic subsides. Hold your breath, et cetera. Or maybe they'll allow you to take out 10% or some little something, but they're not going to allow you to get your money back because they know they can't pull this Conjuring Act again. I mean, last time they guaranteed every money market fund in America. So what they said was, well, don't worry about it, we will guarantee them, and that helped to calm down the crisis. But that won't happen again because it's politically unpopular. They didn't like the bailouts, and they feel that there's moral hazard, that the money market funds are allowed to be reckless because they know the guarantee is waiting in the wings. So next time they're going to say you can't get your money. By the way, that's going on in other domains. Of course, we saw a preview of this in Cyprus, the so-called bail-in, and my message to investors is don't think Cyprus is a far away off-the-run place. This is coming to a bank near you. So you'll find that bank accounts for failed banks, they may be partially confiscated or taken as part of the bail. And I think you'll get the insured amount, but anything you have in over and above the insured amount is at risk. You're basically an unsecured creditor of a failed bank. Money market funds will be frozen. I think you'll see this in other asset classes as well. So two things will happen next time. One, they'll create liquidity from the IMF with very large systemic implications for the dollar. And two, they'll fight the liquidity panic by saying you cannot have your money. So this is the response. It's, again, this is not an invention. This is all available, publicly available, either on the IMF website or in speeches by Madame Lagarde or Janet Yellen or rulemaking by the SEC. You just have to sort of connect the dots.
Just picking up on something here, this rule that you discuss of the SEC suggests to my mind, and correct me if I'm wrong, there are at least some people in the halls of power who are looking at the future rather as you're looking at it, even if they're not saying so. And they're anticipating some of the things that you're describing, even if they're not willing to discuss that publicly.
I think that's right. And I criticized policymakers for years, and I continue to do so on the basis that they've got the wrong models. They're using these stochastic general equilibrium models. And I point out on very good evidence that global capital markets are actually a complex system. And the difference between an equilibrium model and complexity theory is not a dry academic debate. Those are completely different dynamics. They work in completely different ways, produce completely different results. So if you're trying to implement policy in a complex system using an equilibrium model, you'll get it wrong every single time. And we talked about that in our last interview, John, and that's available on the Physical Gold Fund website in the archive. So interested listeners can tune into that. So we don't need to repeat that whole theoretical distinction, but it's a very important one. But lately, I'm seeing many signs that the policymakers are saying to themselves, they may not embrace complexity theory, they may not share my views of how this will collapse, but they are coming around to the view that it will collapse. And what they're saying is, okay, for a few years, we've been trying to get the economy moving again. We've been trying to achieve the famous escape velocity. We've been trying to get the velocity of money going. We've been trying to create inflation. We've failed in every one of those respects. The economy is still in a depression. We do not have a self-sustaining recovery. We have a technical recovery in the bare statistical sense, but not a real recovery in the self-sustaining sense. So, and we're not seeing the inflation. It may come later, probably will, but not yet. So in all of their policy goals, they've failed. I don't see any signs that they, as I say, they really embrace complexity theory, but they seem to be coming to the realization that the system will collapse again. They failed in their main mission to get the economy moving. We're not getting the growth we need to pay the debt. The debt's piling up. The derivatives are piling up. The banks own Washington. The system's out of control. It will fail. And so they're beginning to say, okay, another failure is coming, a collapse greater than 2008, a collapse bigger than the central banks. What can we do about it? And as I say, I've just mentioned the two things they can do about it: print money from a source other than central banks, which would be the IMF, and resort to bail-ins, freezes, suspensions, etc., so people can't get their money back. And the fact that we're seeing signs of that tells me that they're expecting it, that the regulators and the policy elites themselves, not just commentators like myself and some others, but the regulators themselves see the collapse coming and they're getting ready for it. Otherwise, why would you do these things? Now, in my background, a lot of it anyway, is in the hedge fund and alternative world. I've literally worked at, launched, advised, counseled scores of hedge funds and had occasion to read literally hundreds of hedge fund offering documents, and I've never seen one that did not have a suspension clause. Now, you find, on page 40 in the fine print of a hedge fund offering document, if anyone actually reads it, there's a provision that says, notwithstanding, liquidity and notice provisions and end of lockup, notwithstanding all that, we, the management company, reserve the right to suspend redemptions in our sole discretion if that's necessary to act in the best interest of all investors. What that means is that if you have a kind of a run on the bank in a hedge fund and you've got a lot of illiquid assets and you're selling good assets to meet the demands of the people getting out, well, by definition, that means the bad assets are left for at least the less liquid assets are left for the remaining investors. So there's a kind of unfairness between the investors who are trying to get out and the investors who are trying to stick with you. You, as a hedge fund manager, want to encourage people to stick with you, or at least you don't want to punish the people who are most loyal to you. And so you have these suspension clauses where, if it's normal liquidity, money in, money out, that's fine. If things are operating normally, that's fine. But in a crisis, you want the ability to close the gates and tell investors they can't get their money out. And that is what happened in 2000. Hedge funds. Now, this is completely standard practice in hedge funds. It is not standard practice in money market funds, stock funds, 401ks, bank deposits, et cetera. So what I'm saying is that suspension provision where you call a timeout and tell people they can't get their money back until things normalize is now being imported into all these liquid instruments. Investors seem to be asleep at the switch, as is often the case. Again, it's not that the power elites don't tell you, it's just that they tell you in technical jargon, obscure regulatory announcements, and you have to be a little bit of a geek to first of all find it and secondly connect the dots. But so I would say that if regulators and central bank governors and power elites have not got to the stage of embracing complexity theory, they have got to the stage of understanding the collapse is coming, and they're beginning to take concrete steps. And those steps are not good news for investors.
Well, it's time to turn to the questions that we've had from our listeners, Jim. And I've got one here that's actually also about the coming collapse, specifically a crisis in the stock market. And I have a question from @inline6 who would like to know your best guess on the miners' performance, the performance of, I think, precious metal mining stocks versus the rest of the market if and when we get a big sell-off or correction.
Sure, and I've written and spoken and thought a lot about gold, but my involvement is almost always related to the physical metal and, of course, the direct derivatives and the use of gold as a monetary asset. I do not hold myself out as an expert in mining stocks. I'm not a stock picker. I'm not really an equity analyst as such. I'm more of a global macro analyst. And of course, I think about gold in the monetary context. But I would say the following. At the end of the day, gold mining stocks follow gold to a great extent. If anything, they're more volatile. Traditionally, gold mining stocks have been described as a leverage bet on the physical metal. There are technical reasons for this, having to do with the difference between fixed costs and variable costs. But basically, when gold goes up, mining stocks should outperform. When gold goes down, mining stocks may underperform, actually fall faster than the metal itself. So it's a sort of a more volatile leverage bet on gold. I would say a couple things. Number one, if you want to make a leverage bet on gold, just use leverage. I don't use leverage. I don't recommend leverage in gold. I think gold is volatile enough that you don't need to add leverage to it. But if you think mining stocks are a way to make a leverage bet on gold, why don't you just buy or sell gold using leverage in COMEX futures or with borrowed money? So that's one way to think about mining stocks. But the other important thing about mining stocks, they're completely idiosyncratic. In other words, miners are not generic. And I find a lot of investors treat them as generic. They say, oh, well, I look at the miners, plural, as if they're all the same. Well, they're not. I mean, some of them are well-run companies, very well established, very well capitalized. They've been around for a long time, and I would expect they'll continue to be around for a long time. Others are highly speculative. Some of them are frauds. And so as an investor, how do you sort out the frauds from the well-run companies? Well, you can do it, but that's a lot of work. You have to probably meet with management, travel to the mines, certainly read the balance sheet, read the footnotes, go to the meetings, listen in on the calls, et cetera. You have to basically be an equity analyst. I can do that, but I don't do that because it takes an enormous amount of time and it's not my subject matter expertise. And there are some people out there like John Hathaway and his colleagues at the Tocqueville Gold Fund, and I think Doug Casey and the folks at Casey Research. There are some people doing solid research in gold miners. But even there, I guess I would say if you want to be in the sector, and I think that gold. As I say, I prefer the physical metal itself. But if you want to be in the sector, I would recommend sticking to the largest, highest cap miners. And here's why. The low cap or startup or more speculative miners are in very bad shape. We all know how that has performed, and those stocks have been beaten down. And people say, well, gee, if they're beaten down enough, isn't that a good time to buy? Well, there's a better time to buy, which is when they go bankrupt. In other words, people aren't out to do the miners any favors. The little investors tend to think that you can kind of buy low and get in on the upswing, and you can here and there. But the more savvy investors, the larger companies and the predators like Goldman Sachs, would actually say, well, I'll drive you into bankruptcy and buy your assets in a bankruptcy sale. That way I get the mining assets, but I don't have to do you any favors. And so just because things are low doesn't mean they can't go lower. Just because a company's in distress doesn't mean it's time to buy, because I think for some of these, the time to buy is to actually buy the assets out of bankruptcy, which is more of a game for investment bankers and the big guys and hedge funds and the bottom fishers rather than small retail investors. So it's tempting. It looks like there's a good pop, but if you want leverage, take it straight, not on the rocks, so to speak. And if I were in miners at all, I would stick to the big ones.
Well, more broadly, Jim, before we move off from the subject of gold and the stock market, how do you associate the performance of gold in relation to the stock market? We often talk about the relation of gold price to inflation or the performance of the dollar or to currencies. But what about the relationship between these two worlds, the world of gold and the world of the stock market? How do you anticipate that correlation?
I don't think there is a correlation, John. It's a very good question, a very important question. And a lot of investors think of stocks and gold as a trade-off. They say when things are good, by good, I mean, strong economic growth and low inflation and price stability. I don't want to own gold. I want to own stocks. But when things are rocky or inflation is getting out of control or the economy is in a recession, I'd prefer to dump my stocks and have a safe haven like gold. And I've even had people more or less suggest to me, Jim, you're an expert on systemic risk and potential collapse. And what I want you to do is call me up at, 3:30 the day before the stock market crashes and let me know so I can sell all my stocks at the close and buy gold. And of course, I tell them that it doesn't work that way, that I'm not going to know the day. I think I have some insight into the magnitude of the coming collapse and the implications of it, as we've discussed, and the fact that it's sooner than later, meaning perhaps months or a year away or 2 years away. But I don't think we're going to make it 5 years or I certainly no need to go out any longer than that. So I think you can see that coming. And I've said the time to prepare for that is now. The time to acquire gold is now, because you may not be able to get it when this crash comes. But the notion that I could somehow know, it's going to happen tomorrow is nonsense. And I tell people that. But having said that, just to get to a technical and fundamental answer to your question, John, I see no correlation between gold and stocks. Sometimes stocks go up and gold goes up along with it. And sometimes gold goes up and stocks go down, and sometimes gold goes down and stocks go up. In a very short time frame, a few months or 3 months, you can find these things moving together. In 2012, for example, 2011, 2012, we saw gold and stocks going up together. That was the so-called risk-on trade. It's risk-on, risk-off, depending on whether Angela Merkel got out of bed on the right side or the left side. And, in those days, because I was always baffled by that, because first of all, I don't think there was a correlation. Secondly, when did gold get to be the risk-on trade? I thought that was when you wanted to run for cover. But be that as it may, in very short periods, you can find a correlation. But anyone who knows anything about statistics knows that that's just noise. And the proper way to do these regressions is to use much longer time frames. Actually, the longest time frames you can find, assuming conditions are comparable and you're doing an apples-to-apples comparison. The longer the regression period, the more meaningful I think the data is. And so if you said, do I see a linkage between stocks and gold? I would say no. I could see, for example, the economy getting stronger in nominal space and inflation picking up. And I could see that causing stocks and gold to go up together, because stock investors would say happy days are here again. And gold investors would say, here comes the inflation. And those things may not end up in the same place, but they can start out and progress in the same place. So there's an example where stocks and gold might move together. On the other hand, if inflation gets out of control, the Fed gets behind the curve. Inflation is a wealth destroyer. It tends to be very bad for capital formation at the end of the day. And so you could have the stagflation scenario where we don't have growth, but we do have the inflation. This would be very similar to 1974-75. In that world, what you would see is down gold going up for very good fundamental reasons. So, and by the way, I don't recommend 100% of anything, meaning I've always recommended 10% of your investable assets in gold. I think if you want to be a more aggressive investor, maybe 20% is the right number. But for the typical investor, I think 10% is plenty of insurance, plenty of protection. And you might have some stocks in your portfolio as well. So, I find that people want to pigeonhole you and drag you into these debates, or Jim Rickards says something good about stocks, it means he's not in gold, or vice versa, and that's nonsense. I own gold, I own land, I own fine art. I invest in hedge funds and alternative investments that have stocks in their portfolios, but these might be long-short equity funds that have short positions, or they might be global macro funds that are making directional bets in a few sectors where things might do fine. I mean, there's nothing wrong with stocks that have underlying hard assets. My example there I've also mentioned before is Warren Buffett buying railroad, oil, and natural gas. Well, Warren Buffett is a classic stock investor, but he's buying companies that have hard assets such as energy and transportation and land underneath them, and those stocks might do just fine. So I don't see a correlation between stocks and gold. I think there's a place for both, carefully selected, in a portfolio. I don't think we have to get into false dichotomies or false binary choices. The right portfolio is one that has a good mix of assets, but gold should certainly be part of the mix.
Thank you. Let's go back briefly to the Federal Reserve for a question from Stephen James. And he asked you, if Fed member banks no longer received a 6% dividend, would they have any incentive to join? And perhaps you could first explain the dividend Stephen is referring to, and a little bit about the relationship of private banks to the Federal Reserve, so we can address his particular question.
Yeah, I think that's it's an important question, but I think you framed it the right way, John, which is you have to take a question like that and put it in context. And I think there might be a little confusion about what it means to be a member bank and what this dividend is, et cetera. So let's just start with the fundamentals, and then I'll kind of work my way along to a specific answer to the question. The Federal Reserve is a complicated multi-tiered system. So the most attention is paid to the Board of Governors in Washington. The Board of Governors has 7 members. There actually have been a lot of vacancies recently, so they've been operating with as few as 3, sometimes 4 members. And there's still 2 vacancies today, so they only have 5 members. But there are 7 seats, so when there are no vacancies, the Board of Governors will have 7 members. But we also have 12 regional Federal Reserve banks. These are in the major economics, centers around the country. So there's the Federal Reserve Bank of New York, the Federal Reserve Bank of Boston, the Federal Reserve Bank of Philadelphia, San Francisco, Dallas, et cetera, around the country. Now, those regional Federal Reserve banks are privately owned. They are not owned by the United States government. They are not principally agencies of the United States government. They're owned by the banks in those regions. So Citibank is in the New York region. They own stock in the Federal Reserve Bank of New York. JP Morgan is in the New York region. They own stock in the Federal Reserve Bank of New York. And whenever you say this, people act like it's some deep, dark conspiracy. Oh, my goodness, did you know that, et cetera. It's been this way since 1913, and it's known. It's not a secret. And so the Federal Reserve Bank is privately owned at the regional reserve bank level. But a lot of the control is in the Board of Governors. The Board of Governors are appointed by the President of the United States and confirmed by the United States Senate. So here you have the President and at least one House of Congress, the Senate, controlling the Board of Governors. So what is that when you have a privately owned system that's directed by a group appointed by the political leadership? That really is the model of fascism. If you go back to Mussolini, fascism is another one of those words that is not well understood. It's thrown around as a pejorative. Somebody wants to denigrate someone else, so they say you're a fascist, or right-wingers call left-wingers fascists, and left-wingers love to call right-wingers fascists, etc. I just like to look at the meaning of the word, put it in historical context, and understand it. And fascism was a system, really came out of the left wing, out of the socialist movement in Italy after World War One. It was created, at least in its modern form, by Benito Mussolini. And what it was the unification of big business and big government. This is in contrast to a totalitarian system. In a totalitarian system, such as what Stalin had or what Mao Zedong had in China, they try to control everything. So they own the businesses. They direct everything. They make all the appointments. They dictate output. They dictate the economic structure. So they control thought. They arrest you for thinking the wrong things. They control them. That's a totalitarian system. In a fascist system, they don't try to control everything, but they partner. Government and business partner to, in effect, control the system. And that's what I see in the Federal Reserve, is a partnership between government, which controls the Board of Governors, and the big banks, which own the regional reserve banks. And if you say, what is that? The best historical name for it, I think the proper name would be fascism. So it's really, I call it a neo-fascist system. Now, so that's what we have. And so it's an endless source of confusion, because people who don't know it's privately owned point to the political process, and people who want to reject the fact that politicians are involved point to the private ownership, and they're both right. So it's another one of these false dichotomies. I wouldn't get too hung up on it. I would just, again, connect the dots and see it for what it is. Now, just to make it a little more complicated, policy, meaning interest rate policy, and other kinds of experiments such as QE, 1, 2, 3, etc., are not determined by the Board of Governors. They're determined by the Federal Open Market Committee, the FOMC. The FOMC is another hybrid which has seats consisting of the 7 governors, 7 members of the Board of Governors, and 4 regional reserve bank presidents. So you have 11 members of the FOMC. But there is more nuance. One of the regional reserve bank seats is permanent, which is the Federal Reserve Bank of New York. They always have a seat on the FOMC. The other 3 rotate among the other 11 regions. And so those are different people at different times. And that's very important from a policy perspective, because right now, 2 of the regional reserve bank presidents who are on the FOMC are Richard Fisher of Dallas and Charles Plosser of Philadelphia. They are superhawks. And also, as I mentioned earlier, you have some vacancies. So when the Board of Governors show up for their FOMC seats, they're supposed to have 7, but right now they only have 5. So instead of 7 to 4, governors to presidents, it's 5 to 4 governors to presidents, which is much closer to a tie. And among the presidents, 2 of them are superhawks, Fisher and Plosser. Now, this will all change in 2015. The president is in the process of filling the vacancies. They'll have Lael Brainerd. She should be confirmed soon. I expect her to be a Dove, or at least, kind of go along with Janet Yellen. And then that leaves one more vacancy, and presumably the president will fill that before the end of the year. So you might see the governors up to a full 7 seats by next year. And going back to this rotation I described, Plosser and Fisher come off the FOMC to be replaced by Charles Evans of Chicago and Dennis Lockhart of Atlanta, who are super doves. So, and the governors historically are more dovish than the president. So you're going to go from a very hawkish very hawkish FOMC in 2014 to a very dovish FOMC in 2015, which is one of the reasons I've been talking about QE4, because it's clear that the QE3 taper is a disaster. The Fed began the taper in December 2013. They will finish it by October. But they have tapered into weakness. That weakness is becoming more apparent in the data. It will become more apparent between now and the end of 2014. So by 2015, with weak data, a weak economy, a failed taper, and a more dovish FOMC, I expect that the Fed will have to go to something like QE4. So that's an overview of the system. It's a hybrid fascist system. It's hawkish this year, more dovish next year. And but just to take that a step further, to go specifically to the listener's question, The 6% dividend, that's a dividend you get on your stock. So it's not a question of joining the system. By the way, there is such a thing as the Federal Reserve System, and banks do join it. But joining, which is sometimes required, sometimes optional, depending on whether you're a federal bank or a national bank or a state bank or a large bank or a small bank, a lot of variables there. But that's really just joining so you can join the payment system and payments and settlement, use the FedWire and other facilities of the Federal Reserve. It has some impact on deposit insurance, et cetera. So joining the system is a technical thing that turns on your status as a bank and depends upon what facilities you want to use. But that's not what the listener is asking about. The 6% dividend has to do with the stock. That is what it is. I mean, whoever owns the stock gets the dividend. That stock is non-transferable. You can't sell it. You can't buy it. The only time it moves around is when banks merge. So when J.P. Morgan bought Chase Manhattan some years ago, or merged with Chase Manhattan, J.P. Morgan would have been a stockholder and Chase Manhattan would have been a stockholder in the Bank of New York. So their stockholders would have been combined as the banks combined, which is interesting, by the way, because we're seeing more and more concentration of banking assets in fewer and fewer hands, which means the stock in the Federal Reserve Bank of New York is being concentrated in fewer and fewer hands. So there's sort of less diversity, less dissent all around. Not that these big banks disagree with each other very much, but to the extent that they might, even that's being eliminated by the concentration of the holding. So, yes, you do get a dividend on your stock, but that's not something you can sign up for. It comes from owning the stock, and that's not something you can buy or sell.
Okay, thank you. That's very informative about the Federal Reserve System. Let's turn again to coming crash. And Michael Yan asks, is there a danger that the US government will take everyone's 401k and give us annuities instead?
Well, first of all, there is a danger of that. I don't want to rule anything out. When I say anything, confiscation, bail-ins, asset freezes, special taxes, windfall profits tax, swaps of stocks for annuities, just put everything you can think of on the table, and it's all on the table. Now, so the question is it possible? The answer is yes. When things get bad enough, governments will do anything. It's very important for, I find that too many analysts, they put on their market hats, they take what they learned in business school or what they learned in economics or what they hear on TV, and they put on these economics hats and try to analyze everything in terms of, rational markets and efficient market hypothesis and the normal distribution of risk, which is all garbage, by the way. I mean, that's not just an opinion. It's empirically, scientifically garbage, and that's been very well demonstrated, including in my books, but also by others. But what people miss when they've got their market hat on is the government hat. Governments don't go down without a fight. And if an economy is in distress and money riots are breaking out and people are demanding scalps and things are going from bad to worse, don't rule out anything. So, yes, this is something that could happen. Now, is it likely? I think what's more likely is what I talked about earlier in the interview, John, and I don't need to repeat all that, but they'll just freeze the assets. So I think what's more likely is they'll say, okay, we're not going to steal your 401k, but we're going to tell you can't get it. Even if you're, over, I forget what the age is, I think 62 and a half, we're not going to let you withdraw some 401ks or IRAs have features that allow you to take loans out against the asset value to pay for medical expenses. I think a new home. There's a list of things you're allowed, cars actually, I think there's a list of things you're allowed to use the money for, et cetera. You'll find that you won't be able to get the money out. You won't be able to cash it out, even with the penalty. You won't be able to take loans. You won't be able to do normal withdrawals. They'll just freeze your assets. So again, without repeating all the prior analysis that we went through, I think this question is just a subset of the larger issue of how do you stop a panic. And the last time they printed money, and the next time they're just going to say, we don't need to print money because you can't get your money back.
Well, let's turn to another question, this time about the dollar. Matt Longagan asks, do you see the dollar appreciating against any major currency pair? Jim, this is a question about the prospects for the dollar, but it could also be taken as a question about the currency wars, which I think you touched on a little bit earlier. So maybe you could very briefly give us your snapshot of what you see happening to the dollar currently.
Sure, and it's a very good question, very insightful question. People often ask me, is the dollar going to go up or down? And I say, compared to what? In other words, you can't really talk intelligently or thoughtfully about the dollar without describing what you're comparing it to, because it's just a counting device. It's a measuring device. And so are we comparing it to the euro? Are we comparing it to Singapore dollar, Australian dollar, gold? And I think for this purpose, we can think of gold as an alternative currency. One of the raps on gold or criticism of gold is that it has no yield. Why would you invest in gold if it has no yield? And I say, well, just take a dollar bill out of your wallet and stare at it for a while and tell me if it has a yield. The answer is it doesn't. And money doesn't have a yield. If you want a yield, you have to convert your money into something else. It could be a bank deposit, a money market fund, stocks, bonds, et cetera. But you're not going to get a yield on money. You never do. And if gold is money, which in my view it is, it shouldn't have a yield. So that's why saying gold doesn't have a yield is not a valid criticism, because money doesn't yield anything. You have to take risks to get yield, and that means turning your money into something else. So for this purpose, let's think of gold as money. So will the dollar appreciate against anything? I think, sadly, for the Fed and the Treasury, it will probably appreciate against the Chinese yuan and also against Japanese yen. So those are two currencies that will be going down against the dollar for very different reasons. Japan, the U.S. has given a green light to that knows in the currency wars. The main idea of the currency wars is to cheapen the dollar against everything. And why do you want to cheapen the dollar? Well, everyone says, oh, it's to promote exports, help Boeing sell airplanes. Well, at best, that's a side consequence. The real reason you want to cheapen the dollar is not to promote exports, but to import inflation. People forget that the U.S. has a current account deficit. The U.S. buys more than it sells. So while cheapening the dollar may help you sell a few things, although I'm actually skeptical about that, what it really does is it increases the cost of everything you buy. So, the iPhones, the textiles, the cheap clothing you like to get at Costco. I like a bargain as well as the next guy. I'm always happy to go to Costco and get something that used to cost $100 for $19. I think that's a good deal, but that comes from imports. So cheapening the dollar increases imports, which is a way to get inflation into the supply chain in the United States, which the Fed desperately wants. So that's the real reason the U.S. wants a cheaper dollar. Now, Japan is an exception to that because the U.S. is desperate, but Japan is more desperate. It's either the third largest economy in the world, if you believe the Chinese, or perhaps still the second largest economy in the world if you adjust the Chinese data for a lot of games that are being played there. So, but either way, it's a very significant part of the economy. The United States has been in depression for 6 years, but Japan has been in depression for 25 years. And so they need the help more than we do. So the U.S. has given Japan a pass, if you will, to let the yen go down against the dollar, even though we want the dollar to go down against everything else. So I do see the dollar appreciating against the yen. The other pair would be the Chinese yuan, and there the U.S. doesn't want the yuan to go down at all. We want the yuan to go up. But for better or worse, the yuan is controlled by China, and China doesn't care what we think. And so right now it suits China's policy goals to have a cheaper yuan because their economy is stalling. They're on the precipice of a credit crisis. They've got social instability. And the only time the Chinese let the yuan go up is when they're worried about inflation. When inflation gets hot in China, they will let the yuan go up, even though they don't really want to cool off the inflation, because inflation is more socially destabilizing in China than unemployment. Tiananmen Square was partly the result of inflation. The collapse of Chinese dynasties through the millennia has been driven in part by inflation. So it's something that communists very much fear, but that's their domestic policy goal, not the preference curve of the United States. So if you want to understand the Chinese, CNY/USD or the Chinese yuan dollar cross rate, just look at Chinese inflation. If it's going up, the yuan may appreciate a little bit. When inflation cools off, the yuan will go back down again, regardless of what the United States says. Right now, inflation is under control in China. They have other problems, but inflation is not one of them, so the yuan's going down. So I would look for the dollar to go up against Japanese yen and Chinese yuan, but it's going down against everything else, including, obviously, sterling has been strong. I do expect a currency crisis in sterling. A lot of people have I don't think correctly interpreted what I mean by that. They've taken it to mean that I said the sterling is going to go down, which it hasn't. It's been very strong. I'm actually making a different statement. I'm not saying it won't go up in the short run. I'm saying when there's a currency crisis, we don't have one yet. We haven't had a currency crisis since the euro crisis began in 2011, and I was the one at the time who said the euro was strong and getting stronger, which it has. Everyone else said the euro was going to go to, parity or below. It was going to fall apart. And I said that was nonsense. The euro got a lot stronger, exactly as I expected. I do expect a currency crisis in sterling, but not yet. It'll be the next one whenever that comes along. In the meantime, sterling is getting stronger. The euro is getting stronger. The other strong currencies are Singapore dollar, Korean won, and actually the Australian dollar has shown some strength, although the Reserve Bank of Australia is very conflicted about whether they should join the currency wars or not. So big picture, I see the dollar down against everything except China and Japan, with the caveat that gold will be very volatile. So the trend of the dollar is down against gold, but in the short run, the dollar could rally vis-a-vis gold based on market manipulation and other technical factors.
Oh, well, briefly and finally, talking about gold, let's just take the question from T. Marks, who asks, how long does one have to buy gold before it runs out?
I love questions they answer themselves. If you're asking that question, the answer is now's the time. In other words, I think that the listener asked a very smart question, which is, how long do you have? The answer is, I don't know exactly. But the fact that I don't know and no one else knows, and the fact that the question is being asked, is a pretty good sign that you ought to be buying it now.
Well, thank you, Jim Rickards. This has been a long conversation, but a very rich one. And thank you especially to our listeners for the fascinating questions you've contributed. And we look forward to further questions from you, by the way. You can follow Jim Rickards on Twitter. His handle is @JamesG.Rickards. And when you want to share a question for our next podcast, just use the hashtag #AskJimRickards followed by your question. And wherever you post that, on Twitter, we'll find your question. We really love to have these questions. They stimulate a very lively conversation here. Thanks, Jim, once again, and goodbye to you.
Thank you, John.
And thank you to our listeners. And just to remind you, you can find Jim's new book, The Death of Money, at Amazon and any good bookstore. Get yourself a copy. And goodbye for now. We look forward to joining you again soon.